Welcome to the deep dive. We are so thrilled you're joining us today.
Yeah, thanks for being here.
You and I are going to be looking at a really fascinating situation unfolding in the tech world.
Truly fascinating. It's a critical moment.
Right. We are taking a comprehensive look at Oracle Corporation, right on the heels of their highly anticipated Q3 fiscal 2026 earnings release.
Which is huge for them, and honestly for the broader tech sector as a whole.
Oh, absolutely. And we have a massive stack of materials in front of us today for you.
We really do.
We're pulling from fresh, hot off the press financial releases directly from Oracle. We've got live earnings call blogs from T247 Wall St, deep analyst notes from Barclays and Jefferies,
Yep.
and some really intricate valuation models from TIKR and Guru Focus.
There is a sheer volume of data we have to parse through today. It really paints a picture of an industry in massive transition.
It does.
Yeah.
And our mission for this deep dive into the source material is pretty straightforward. We need to figure out if Oracle...
Easy database company.
Right. The legacy company that is now aggressively trying to become the ultimate AI cloud landlord. We need to figure out if they're actually a good investment today.
Especially considering that, well, before this latest earnings report, its stock had plunged 54% from its previous highs.
Yeah, a 54% drop.
It's a classic battle between historical perception and future potential. I mean, the market has been incredibly skeptical of the massive costs associated with this transformation.
Right.
For the better part of a year, investors have been waiting for proof that Oracle's grand vision is actually translating into tangible, bottom-line reality.
Not just corporate buzzwords.
Exactly. Not just buzzwords.
Okay, let's unpack this. Let's start with the immediate market reaction.
And those top-line numbers.
Yeah, because they tell a compelling story about where the company is right now.
Yeah.
For Q3 2026, Oracle hit $17.19 billion in revenue.
Which is massive.
It is. That is up 22% year over year in U.S. dollars.
Wow.
Beating the street's estimate of $16.91 billion.
And the profit side was just as strong.
Right. The non-GAAP earnings per share came in at $1.79, pushing well past the expectations of $1.69 to $1.74.
You know, the historical context of those numbers is what really caught my attention in the sources.
How so?
Well, Oracle's chief financial officer, Doug Kehring, he pointed out a crucial milestone during the call.
Oh, the 15-year thing.
Yes. This is the first quarter in over 15 years where both organic total revenue and non-GAAP earnings per share grew at 20% or better.
15 years.
Yeah. They haven't seen this kind of synchronized high double-digit acceleration since the early days of the smartphone era.
That is just a staggering gap in time. And the engine driving that growth is undeniably the cloud.
Unquestionably.
The sources highlight an 84% year-over-year growth in their infrastructure as a service revenue.
The IaaS.
Right, the IaaS, hitting $4.9 billion. And just to put that in perspective for you listening, last quarter that growth was at 68%.
So it's accelerating.
Exactly. The growth isn't just steady, it's accelerating at a massive scale.
And that acceleration directly counters the narrative that Oracle's AI infrastructure build-out was hitting some kind of ceiling.
Right, because Wall Street analysts were heavily demanding a show-me quarter.
They were. They wanted to see if the demand was real, if the clients were actually writing the checks.
And if Oracle would actually deliver the server capacity.
Exactly. Hitting 84% growth proved to a lot of skeptics that they could.
And the market certainly bought into the narrative. I mean, following the release, shares surged about 8% in after-hours trading.
Jumping up from their regular close of $149.40 to around $163.
But, if you look at the underlying mechanics, the revenue they just reported feels like a trailing indicator.
Yeah, you look backwards.
Right. The number that really anchors this entire conversation, and the one you listening should probably care about the most, is their backlog.
Oh, without a doubt. The most staggering figure across all our sources is Oracle's remaining performance obligations.
The RPO.
Right, the RPO. It hit $553 billion.
That is just wild.
It is. That's up 325% year over year.
Over $500 billion.
Yeah. And for anyone trying to model Oracle's future, RPO is essentially a forward demand signal. It represents future contracted money.
Right, so it's revenue that customers have legally committed to paying Oracle.
But that Oracle hasn't recognized on the income statement yet.
Because the actual computing services are still being delivered over time.
Exactly.
It's like taking out a massive mortgage to build a skyscraper, which is terrifying, but having every single apartment pre-leased for the next 10 years before you even pour the foundation.
That is a great analogy. You have this $500 billion safety net of guaranteed future business.
But wait, there's a detail in the analyst notes about how they're managing the hardware for this that I found really surprising.
About the GPUs.
Yeah. Oracle isn't even funding all of these servers themselves, are they?
No, they aren't, and it's a fascinating structural advantage.
Tell me about it.
With these massive AI contracts, customers are so desperate for computing power that they are either prepaying for the GPUs.
The highly coveted chips required for AI.
Right. They're prepaying so Oracle can go buy them, or in some cases, the customers are buying the GPUs directly and literally supplying them to Oracle.
Just to plug into Oracle's data centers.
Exactly.
That sounds great for Oracle's capital burden, but doesn't that also mean the customer holds a lot of the leverage?
How do you mean?
Well, if I'm bringing my own chips, I'm basically just renting the physical building and the cooling systems from Oracle.
It does shift the dynamic a bit, but Oracle's play here is about the software layer that sits on top of that hardware.
Ah, okay.
Once you plug your GPUs into Oracle's architecture, you are utilizing their networking, their database software, and their security protocols.
So it's sticky.
Very sticky. It makes migrating away extremely painful, even if you own the physical chips.
Here's where it gets really interesting. Let's talk about Oracle's competitive moat, because their strategy has shifted dramatically.
It really has.
Historically, the cloud wars were very siloed.
Yeah.
It was Oracle versus Amazon AWS versus Google Cloud versus Microsoft Azure.
You picked a camp and you stayed there.
Right. But Oracle is executing this wild multi-cloud strategy. Instead of just fighting these giants from the outside, they're moving inside their competitors' houses.
It's a strategic pivot that I don't think many people saw coming a few years ago.
Yeah.
The sources note that Oracle's database services are now live in 33 Microsoft regions
Wow.
and 14 Google regions.
Yeah.
And during Q3 alone, they expanded from 2 to 8 Amazon AWS regions.
With a target of hitting 22.
Right.
But if I'm looking at this from an AWS or Google perspective, why on earth would I let a major competitor set up shop inside my own data centers?
Because the customers are demanding it.
Really?
Yeah. Enterprise clients have decades of critical data locked into Oracle databases.
Right.
They want to use Amazon's or Microsoft's AI tools, but they don't want to rewrite millions of lines of code to migrate their databases.
That would be a nightmare.
Exactly.
Right.
So they tell AWS, hey, if you don't support Oracle natively, we'll take our business somewhere else.
Wow. And Oracle capitalized on that leverage.
They did. They're effectively positioning themselves as the foundational layer that sits beneath or within the other major hyperscalers.
Hence the term, the cloud landlord.
Exactly.
They own the critical database software that everyone else needs to rent, regardless of which primary cloud provider a company chooses.
And the financial results of this strategy are pretty clear in the sources. Multi-cloud database revenue is up 531%.
531%.
Yeah. They essentially created a Trojan horse, and everyone invited it inside.
That is brilliant. But beyond the multi-cloud strategy, there was another massive surprise dropped during the earnings call.
Oh, regarding their broader digital footprint.
Right. The CFO quietly confirmed a detail that sent ripples through the market regarding TikTok.
The TikTok stake. Yes.
Following TikTok US's separation from its Chinese parent company, ByteDance, Oracle secured a 15% equity stake in the newly formed entity.
And not just equity. They secured a seat on the board of directors.
The implications of that are vast. I mean, they aren't just hosting TikTok's data anymore.
No, they literally own a significant chunk of one of the most culturally dominant ad platforms on the planet.
And the financial impact of that is expected to hit in Q4.
Which introduces a major new variable for their future earnings and their overall valuation.
Right. But, it's easy to get swept up in these massive backlog numbers and shiny new equity stakes.
Sure.
Let's take off the rose-colored glasses for a second. We have to look at the other side of the ledger.
You're a bear case.
Exactly. If the numbers are this good, $553 billion in backlog,
Yeah.
84% infrastructure growth, why was this stock down 54% from its highs?
And down 22% year-to-date right before this earnings report.
Right. What are investors so afraid of?
In a word, spending.
The CapEx.
Yes, the capital expenditure required to build out this AI infrastructure is astronomical.
Give me the numbers.
Well, Oracle spent $18.6 billion on CapEx in Q3 alone.
Wow.
That is up 55% just from the previous quarter.
$18 billion in one quarter.
And management guided for a total of $50 billion in CapEx for the full fiscal year 2026.
$50 billion in 1 year just on physical infrastructure?
Yeah.
That is a radically different business model than the high-margin software business Oracle investors are used to.
It is a complete structural shift, and it has drastically altered their balance sheet.
How bad is the debt?
The spending spree has pushed their total debt to over $124 billion.
$124 billion.
Yeah.
Yeah.
And because they're spending cash faster than the new data centers are generating it in the immediate term,
Right.
it has resulted in negative free cash flow of roughly $10 billion over the trailing 12 months.
Wait, they're burning $10 billion in free cash flow.
Yeah.
How does that math work long term? They're borrowing heavily and burning cash right now to build the data centers that will eventually service that $500 billion backlog.
Right.
But the interest on that $124 billion debt is ticking every single day.
Exactly. And that creates a severe timing mismatch that analysts are watching closely.
So there's tension there.
Massive tension. The sources highlight a note from Barclays that perfectly illustrates this.
What did Barclays say?
Barclays actually rates the stock as overweight, meaning they generally like the long-term prospects,
Okay.
but they slashed their price target all the way down to $230 just before earnings.
Why the drop?
Their reasoning was massive short-term margin pressures. Oracle has to absorb all these upfront investments, the hardware costs, and massive real estate lease expenses right now.
While the revenue trickles in over the next 5 to 10 years.
Precisely.
And that timing issue isn't just an analyst concern, is it? It's actively playing out in the legal system.
Yes, the lawsuit.
The sources mention a securities fraud class action lawsuit currently making its way through the courts.
Right.
Plaintiffs are alleging that Oracle management misled the market on exactly how fast these expensive data center build-outs would actually turn into billable, recognized revenue.
It highlights the extreme anxiety in the market.
Absolutely.
Investors want the AI growth, but they are terrified of the AI hangover.
The hangover, yeah.
The idea that companies will overbuild infrastructure, take on unsustainable debt, and crush their profit margins in the process before the demand fully materializes.
And it's not just internal Oracle spending that has the market on edge either. We have to look at the broader geopolitical and macroeconomic landscape.
Right, the macro environment.
Our sources, including market monitors like Investing.com and 24/7 Wall St. Schondijk, they note severe market volatility tied to the current Trump and Iran conflict, ongoing shipping disruptions, and what analysts are calling a tariff wildcard.
It's a lot of external pressure.
Now, to be clear to you listening,
Yeah, this is important.
our sources are analyzing this strictly from a financial and market impact perspective.
Yeah, okay.
And we are simply reporting on the data they've provided without taking any political stance.
Exactly.
But the financial reality is, when geopolitical tensions rise, global supply chains for highly specialized AI chips and data center components can get choked.
And when supply chains are tight, shipping routes are compromised, and you're trying to deploy $50 billion in data centers.
And delay is incredibly costly.
Exactly. This raises an important question about concentration risk.
Okay, let's talk about that.
The sources note that a significant portion of Oracle's backlog is heavily tied to a single massive AI client.
OpenAI.
Yes, OpenAI.
Which brings up that Bloomberg report mentioned in the sources that came out right before earnings. It sparked a lot of fear regarding a specific mega project.
The Stargate Abilene project in Texas.
Right.
The report suggested Oracle might be backing out of future expansions for that massive data center site due to local power constraints. When you are that heavily reliant on a single giant client like OpenAI, any rumor of a scaled-back project sends shockwaves through your stock price.
It underscores the profound risk of being the landlord for just one or two massive tenants.
If they sneeze, you catch a cold.
Exactly. Okay, so we've got the incredible backlog and infrastructure growth on one side,
Yep.
and the massive debt, CapEx burn, and concentration risks on the other.
The wall of worry.
This brings us perfectly to the ultimate question for your portfolio. Is Oracle a buy at its current price of around $149?
Wall Street is essentially in a tug-of-war right now. The analyst community is deeply divided on how to price in the short-term pain versus the long-term gain.
You look at the post-earnings moves, and it's all over the map.
It really is.
You have bulls like Jefferies maintaining a buy rating and pricing them at $320, looking primarily at that massive AI backlog.
Right.
But then you have firms like TD Cowen lowering their target to $250.
Barclays dropping to 230.
And Baird pulling their target all the way down to $200 because they're sweating the short-term cash burn and the margin compression.
The variance tells us nobody quite knows how to perfectly model this transition.
So what's the consensus?
Well, if we synthesize all the data across the 37 analysts tracked in our sources, the consensus average price target settles right around $257.
$257. So if Oracle can hit that, it implies a roughly 70% upside from its current trading levels.
Exactly.
A 70% upside is massive for a company of this size. But let's look under the hood. What is the actual valuation math telling us?
At a fundamental level, Oracle is currently trading at a forward price to earnings, or PE ratio of about 19x.
Okay.
Furthermore, Oracle has a PEG ratio of just 0.93.
Let's break that PEG ratio down because it's crucial here. A PEG ratio under 1 generally means the stock is cheap relative to its expected earnings growth. To put that 0.93 in perspective, some of the other AI darlings we track in the broader market are sitting at PEG ratios of 2 or 3.
So the market is still pricing Oracle more like a sleepy legacy database company.
Not a hyper-growth AI powerhouse.
Exactly. And that's the core of the bull thesis. Historically and relatively speaking, the stock looks cheap provided they can actually execute.
And the sources provided a really fascinating detailed valuation model from TCAR that projects out to the year 2028.
Right. The TKR model.
They modeled a target price of $296.
The TKR model is a perfect way to understand what needs to go right for the bulls to win.
Yeah.
That $296 target price implies a 40% annualized return for investors over the next 2 years.
Which is huge.
But it is entirely dependent on Oracle executing flawlessly on 3 distinct fronts.
Break those down for us.
First, they assume Oracle's top-line revenue will grow at a massive 31% compound annual growth rate.
Driven entirely by converting that $553 billion backlog into actual billed revenue.
Exactly. Second, Oracle has to maintain operating margins of roughly 39%.
That is a monumental task.
It is. That means they cannot let the massive costs of data center leases, power bills, and GPU purchases eat away all their profits.
And the third condition.
The model assumes a disciplined 19x exit PE multiple.
Leaning.
Meaning they aren't relying on the broader stock market irrationally inflating tech valuations back to the bubble highs. They are relying purely on durable underlying earnings growth.
It's a high bar. Maintaining 39% margins while building physical infrastructure globally is incredibly difficult.
It's a tightrope walk.
But Oracle's management seems extremely confident they can clear it. I mean, the sources highlight that during the earnings call, management actually raised their fiscal year 2027 total revenue outlook
to $90 billion.
up from their prior guidance of $89 billion.
You don't raise guidance by $1 billion if you're worried about converting your backlog.
True. That upgrade was management signaling to the market, hey, we see the demand, we have the physical capacity coming online, and we are going to capture the revenue.
So what does this all mean? Let's bring the pieces together for you listening. Oracle is in the middle of a high-stakes, incredibly capital-intensive transformation.
They really are.
They're attempting to evolve from a legacy software vendor into the physical backbone of the artificial intelligence revolution.
Yeah.
And Q3 2026 was the quarter that proved they are actually delivering on both the top and bottom lines, hitting that 15-year milestone of 20% organic growth.
Analyzing the source material reveals a clear binary setup for anyone looking at the stock.
Binary how?
Well, investing in Oracle right now is a fundamental bet on executive execution.
Okay.
It's a bet that the management team can expertly balance a gargantuan $124 billion debt load
And a $50 billion infrastructure spending spree against the explosive 84% growth of their cloud infrastructure. If they can effectively burn down that backlog and turn those contracts into cash without destroying their profit margins, the upside is substantial.
It really is the ultimate high-wire act of the tech world right now.
As we wrap up, I want to leave you with a final thought to ponder.
Let's hear it.
It's something buried deep in the technical details of the source material that might represent the true ceiling for Oracle and, frankly, for the entire AI industry.
Okay, what is it?
Well, Oracle is doing an incredible job securing the software layer, they're locking down the GPUs, and they have successfully inked $553 billion in future contracts.
Right.
But the sources mention that Oracle has made a staggering 4.5 gigawatt power commitment to their AI partners.
4.5 gigawatts.
To put that in perspective, a single gigawatt is enough to power roughly 750,000 homes.
Wow.
4.5 gigawatts is the power consumption of a small country.
Connect that physical bottleneck explicitly to the financial models we just discussed.
Right. The TIKR model projects 31% revenue growth, but that math assumes Oracle can physically turn these data centers on. If they are making 4.5 gigawatt power commitments, the bottleneck isn't their sales team anymore. It's local zoning boards, environmental regulations, and power grid transformers.
Because if the physical grid delays those data centers from coming online,
that $553 billion backlog just sits there dormant, while the interest on their $124 billion debt keeps ticking every single day.
right.
Can the physical world generate and transmit electricity fast enough to keep up with the demands of the digital cloud?
Yeah.
That is the real question investors need to be asking over the next 5 years.
You can have all the capital and all the chips in the world, but if you can't plug them in, it doesn't matter. Thank you so much for joining us on this deep dive into the source material. We hope this helps cut through the noise and give you a clearer picture of what's really happening with Oracle's massive transition.
It's a lot to process.
It is. Keep questioning the numbers, keep looking for the why behind the headlines, and we will catch you next time.